The question is that the motion be agreed to. Honourable David Parker.
Thank you, Mr Speaker. Can I also thank the Minister for his contribution and for that lucid description of what covered bonds are and why the government deems them necessary. The Labour Party wishes that we didn't need covered bonds in New Zealand, but it's wishful thinking to say that we don't need them. We have them, and they're pretty hard to unwind at the moment, particularly in the face of a current account deficit, which means that New Zealand is reliant on increasing lines of credit coming through the mainly Australian-owned banks via overseas lenders to those banks, some of whom these days are through these covered bond vehicles. I'll come back to the issue of why the necessity for this is made worse by New Zealand's current economic setting, which lead to a prolonged and entrenched current account deficit, which is not going to be cured under current economic settings. Mr Speaker, as the Minister has fairly acknowledged, the effect of covered bonds is to create a class of lenders to banks who have a security over some of the assets of the bank, namely some of the lending securities that the bank has. So, for example, if a bank borrows money, and they might be borrowing it from an overseas bank or from an overseas sovereign fund, or from some group of bondholders overseas, and then lends that money to New Zealand borrowers, when the bank lends that money to New Zealanders and it's a significant loan, they generally have a form of security which is either a mortgage or a debenture. And the security that that bank has is available to be used in the event that the New Zealand borrower doesn't repay what the bank has advanced to them. Now, until we had covered bonds in New Zealand, all of those securities were available in the event of the bank that had deposits from those overseas lenders to the bank, as well as the New Zealand depositors to those banks. Everyone ranked equally, so that if the bank went belly up because it got into financial difficulty, made some unwise loans, then everyone stood in the same position. And if there was not enough assets to go around when the bank went bung, everyone took a haircut and everyone took the same haircut. Now what we're doing through this legislation is we're saying that there should be a class of lenders to banks who have a priority right to some of the assets of the bank. So some of those mortgages and debentures, rather than being available to all depositors, will effectively have a gotcha over them in respect of these international lenders who've lent through this covered bond market. This did, until the global financial crisis, there were no covered bonds in the New Zealand market. There have been covered bonds, particularly in Europe, for a long time, and indeed in some of the European banks there are high levels of covered bonds, meaning that a lot of the lending is matched with a gotcha over the securities of the bank, meaning that the pool of assets that's available to people that aren't in those covered banks but are effectively unsecured depositors in the bank is smaller. And all other things being equal, if one of those banks goes belly up, then the covered bond holders are effectively protected from getting much of a haircut, and the other depositors, they wear the adverse consequences of that, and the consequences of insolvency are concentrated upon them, and they suffer more of a loss. They take more of a haircut. That's the effect of covered bonds. Thank you, Mr. Clark. Dr. Clark. Now, the effect of that, I know that was a compliment to me, an insult to him. At least to those who are looking across at me rather than down from the top. Mr. Speaker, so the effect of covered bonds is to change that arrangement and to change it dramatically. Following the global financial crisis, when banks were hard-pressed to renew some of their credit lines, the New Zealand banks found that they were able to meet their obligation to repay some of their older borrowings and refinance them so that they could leave money out to the people that they had loaned to in the New Zealand market. In order to do that, they had to enter into the covered bond market. And there has been a benefit to that in New Zealand, because if that didn't happen, then it may have been the case, we'll never know with certainty, but it may have been the case that those banks would not have been able to meet their obligations to their to the people that have lent them money either overseas or in New Zealand. And some of those banks could have been under pressure, and that would have either led to a failure of the bank or to an increase in New Zealand interest rates, both of which could be problematic for New Zealand. And so I have no criticism of the banks, actually, in the face of what happened there, they having expanded credit in the earlier years into New Zealand. I can see why they chose to pursue the covered bond market. Nevertheless, there is something in the criticism that Emeritus Professor Jeff Bertram and others he's formerly from Victoria University, an economist, he's severely critical of the New Zealand regulator allowing these covered bonds to arise. The fact that they weren't used in New Zealand didn't mean that they could be. We found that under the existing legislation, it was possible for them to issue covered bonds because there was no prohibition against them. And so they did, and then the Reserve Bank came after it had happened and said, look, we're going to impose a limit on that through their banking licence or the conditions of their registration as a New Zealand bank. So, Mr. Speaker, reluctantly we've come to the view in the Labour Party that this is necessary. I would like to think it won't be necessary forever, and that one day, when New Zealand is in a stronger economic position and our banks can source more of their funding, even more of their funding from local sources, that we can revisit this and give New Zealand depositors equal priority over all of the assets of the bank, rather than having part of those assets put out beyond their reach through the covered bond mechanism, but at the moment it's necessary. I want to come to the question of the rate. There is a proposal that the limit be 10% of the bank's assets at all time. The Australians have a rule where it's 8% of their assets as at the date of issuance. I personally would have preferred the Australian model. We've gone along with the Reserve Bank advice, but I don't see why we are getting different rules in New Zealand compared with Australia. It's just added levels of complexity at a time when CER is meant to be meaning that we have meant to be having similar rules across both sides of the Tasman. It's unlikely that if you had 8% at the time of issuance, it would rise to more than 10% of the bank's assets. For that to happen, there would effectively have to be a 25% decrease in the size of the bank. And if that's happening, well, there could be problems in that bank anyway. So I preferred the simplicity of the Australian model. I understand the reasons I understand the Reserve Bank has its own reasons for the 10% model, and we can go along with that because there's not a huge difference. Canada has a 4% limit, and we thought about whether that was an appropriate limit, but the advice that we had from officials was that that was too low a limit for New Zealand, because it meant that in respect of our smaller banking institutions, that would mean that the size of issuance that they could have into the covered bond market was so small that there wouldn't be interest in the covered bond market, because internationally they're rather large tranches of money, and 4% of some of our smaller banks like Kiwi Bank would mean that they were closed out of that market, when their competitors, the big Australian market banks, would be able to access that market. And we don't want to create competitive disadvantage for smaller banks in New Zealand in respect of this, because I personally don't want to prefer the interests of the bigger banks over the smaller banks. And I'm sure that's a view that might be held by others in this House as well. In respect of one issue where we do disagree with the government quite strongly, is that this limit should not be easily changed. And we don't think this is something that should be delegated to the Reserve Bank within their discretion to change. We think that it should have to come to the government and say, hey, we think this should be changed. There's a policy decision that then should be taken by a government, not delegated now to the Reserve Bank, as to whether that should be the case. And so we oppose the discretion being given to the Reserve Bank to allow changes to that 10% level in the future without recourse to either the Executive or Parliament. Indeed, you could argue it's so serious that sort of thing should come to Parliament. But we thought, well, at least there should be some executive responsibility for a decision such as that, rather than delegation to the Reserve Bank. I'm just about out of time, so I'm going to say one more thing. That is, the greatest problem that this exemplifies is our current account deficit. Our current account deficit is only funded one way every year. It's more borrowing from overseas, most of it through the banking channel, or asset sales to overseas owner. Every year we do that, our balance sheet of our country continues to get worse. That problem was going to be cured by this government. It was a promise. They said they were going to increase the percentage of exports as they rebalanced the economy towards the export economy. They have not done so. They failed because they won't pull the levers like capital gains tax, addressing monetary policy, or compulsory universal KiwiSaver.
Todd McClay.
Thank you, Mr. Speaker. Pleasure to speak on this bill in second reading.